It's so deeply rooted in our culture that most people never question it. The lie is simple, that the number in your bank account is the ultimate measure of success, that as long as the figure is big enough, you've won the game. But history, both economic and personal, tells a very different story. That story is about people who had more money than entire countries, yet ended up powerless, ruined, or forgotten. And it's also about others who never held vast fortunes but built something far more durable. Value, real value, the kind that doesn't evaporate when the market turns or when the currency collapses. If you understand the difference between wealth and value, you'll see why most people are chasing the wrong prize, and why that race almost always ends in loss. Let's strip the illusion away by starting in one of the wealthiest courts in human history, France, under King Louis XIV. By the early 1700s, the Sun King had turned Versailles into the center of European luxury, gold leaf, marble halls, elaborate gardens. The entire palace was a monument to wealth as display. Nobles spent fortunes keeping up appearances, importing silks from China, sugar from the colonies, wine from Bordeaux. On the surface, France was unimaginably rich, but the wealth was brittle. The economy relied heavily on war plunder, colonial extraction, and debt. Taxes fell disproportionately on peasants while the nobility and clergy contributed little. And so, while Louis dazzled the continent with opulence, the financial system beneath it was hollowing out. Fast forward to the early 1700s, and John Law, a Scottish financier who became France's Comptroller General of Finances, tried to fix the problem with paper money and the Mississippi Company. At first, it worked like magic. Fortunes multiplied on paper. Nobles and merchants saw their wealth grow faster than they'd ever imagined. But it wasn't real value. The Mississippi Company's profits were inflated, its land in Louisiana oversold, and when confidence collapsed in 1720, the paper wealth vanished almost overnight. Those who had chased the illusion of fast money were ruined. Those who had kept tangible assets, land, production skills, weathered the storm. This was one of the earliest examples in modern Europe of the difference between apparent wealth and intrinsic value. The pattern repeats everywhere. In the 1920s, American investors rode the stock market like it was a one-way elevator to the top. Cars, radios, and skyscrapers symbolized unstoppable progress. Bankers and speculators leveraged themselves to dangerous levels, creating fortunes from thin air. But when the crash of 1929 came, that wealth evaporated. The only survivors were those whose assets still held utility, farms that could grow food, factories that could produce essentials, businesses that solved enduring needs. The same lesson that had been ignored in France was ignored again in America. Money is a claim on value, not value itself. If the underlying value disappears, the money becomes meaningless. Here's the uncomfortable truth. Most of what we call wealth today is fragile. Stocks are priced based on future expectations, not guaranteed output. Real estate values depend on interest rates and market sentiment, not just bricks and mortar. Even currencies, the lifeblood of the financial system, are only as strong as the trust people have in the institutions that issue them. Lose that trust, and history shows how fast wealth can turn to dust. The Weimar Republic in the early 1920s, Zimbabwe in the 2000s, Venezuela in the 2010s. In each case, people who measured their fortune in the local currency went broke, while those who had value in hard assets or transferable skills preserved something of their prosperity. So, if wealth is the number, what is value? Value is the capacity to produce, to endure, and to be useful, regardless of the financial climate. Value can be a skill you can trade, a network you can rely on, an asset that generates essential goods or services, a piece of knowledge that allows you to solve urgent problems. Value holds when markets panic. It holds when currencies fail. It holds because people need it, and that need is the most resilient currency of all. One of the clearest examples of this comes from Japan's economic bubble of the 1980s. At its peak, the land under the Imperial Palace in Tokyo was said to be worth more than all the real estate in California. Japanese corporations were buying up famous landmarks abroad, from the Rockefeller Center in New York to golf courses in Hawaii. On paper, Japan was unstoppable. But when the bubble burst in 1991, trillions of dollars of wealth evaporated. Companies went bankrupt, stock prices collapsed, property values plummeted. Yet the country didn't disappear because Japan still had something more important: a highly educated workforce, a manufacturing base that could produce world-class goods, and a culture of precision and quality. That was value. It didn't prevent pain, but it provided the foundation to recover. This distinction matters because our modern financial system constantly blurs the line between wealth and value, and that confusion is profitable for those in power. Governments prefer citizens who measure their success in numbers on a statement rather than in the resilience of their personal economy. Corporations prefer customers who chase the latest financial products, not those who invest in real, tangible skills or durable assets. The more you confuse wealth for value, the easier it is to trap you in cycles of dependency. In ancient Rome, The richest senators owned vast estates, but their true power came from controlling essential resources, grain, olive oil, wine, that the city relied on. When Rome's currency, the denarius, was debased over the centuries, those who held only coinage lost purchasing power. But those who held value in the form of agricultural output, mining rights, or shipping fleets kept their influence. This is the same principle that saved some during the hyperinflations of the 20th century and the market crashes of the 21st. The reason most people never become truly financially free is that they chase wealth without building value. They focus on accumulation without asking the deeper question, what is this wealth actually made of? What backs it? If your fortune is tied entirely to a market index, a corporate salary, or a currency that can be devalued, you may not be as rich as you think. Real financial freedom comes when your livelihood doesn't depend on the constant stability of a system you don't control. In the modern era, this means diversifying not just your investments, but the forms of value you hold. It could mean owning productive assets, land, tools, technology, that can serve a need in any economic climate. It could mean mastering a skill that will always be in demand, whether that's coding, construction, food production, or problem solving in high-pressure environments. It could mean cultivating relationships that can provide opportunities or protection when formal systems falter. All of these are forms of value that can outlast paper wealth. The irony is that the people most obsessed with looking wealthy often end up the most vulnerable. History is filled with examples of elites who lived lavishly but had no real value to fall back on when the tide turned. The French aristocrats of the late 18th century, the robber barons of early 20th century America, whose empires collapsed after regulatory changes, the tech millionaires of the early 2000s, who were rich on stock options until the bubble burst. All were wealthy until they weren't, because wealth without value is like a castle made of sand. And this is where the real challenge and the real opportunity lies. The distinction between wealth and value isn't just an interesting historical observation. It's the dividing line between those who survive economic storms and those who are swept away by them. The same forces that bankrupted French nobles, collapsed Wall Street in 1929, and deflated Japan's bubble economy are still at work today, just dressed in modern clothing. Understanding this difference gives you the power to step away from the illusions and start building something that lasts. Something no market crash, currency devaluation, or political shift can take from you. We need to start by stripping away one of the most seductive lies the financial system sells you, that a high number on your bank statement means you're secure. History is filled with people who thought they were wealthy, right up until the moment they weren't. In the Roman Empire, merchants could accumulate fortunes in denarii, only to find those coins steadily debased by emperors desperate to fund wars and construction projects. By the 3rd century after Christ, a denarius that once held almost pure silver contained barely a trace of it. Prices soared, trust collapsed, and merchants learned too late that their wealth was an illusion because its value had been stolen from under them. The metal was the same, the image of the emperor was the same, but the purchasing power was gone. That's the first lesson. Wealth measured in a currency controlled by someone else can vanish without warning. Jump forward to the Weimar Republic in the early 1920s, and you'll see the same principle playing out in more extreme form. A worker could be paid at noon, and by the time they bought bread on the way home, the price had doubled. Savings accounts, built up over decades, were reduced to the value of a bus ticket. People hauled money in wheelbarrows, not because they were rich, but because the paper was worth less than the kindling it could make for a fire. The real wealth in that period belonged to those who had assets outside the collapsing mark: land, foreign currency, gold, or goods in high demand. The lesson is brutal but consistent. The number of zeros on your paycheck is irrelevant if the value underneath it is rotting away. Modern investors like to think this is ancient history, but the echoes are deafening today. Take Japan's asset bubble in the late 1980s. At its peak, the land under Tokyo's Imperial Palace was estimated to be worth more than all the real estate in California combined. Stocks were trading at dizzying price-to-earnings ratios, and fortunes ballooned overnight. Then the bubble burst. By the early 2000s, Japanese equities had lost over 70% of their value, and real estate prices had been crushed for more than a decade. People who measured their wealth purely in the market's inflated prices discovered they had built castles on sand. Meanwhile, those who had diversified into assets with enduring demand weathered the storm. The crucial insight? Value is rooted in utility, scarcity, and resilience, not in speculative euphoria. So, what does this mean for you right now? It means the house you own, the stocks you hold, even the currency you earn, all exist inside a system that can inflate, devalue, or reprice them overnight. Financial education isn't about memorizing terms from economics textbooks. It's about understanding the hidden levers of the financial system, how central banks, governments, and major institutions can shape, manipulate, or distort the prices of everything you own. When you grasp that, you start asking the only question that matters. What will still hold value if the system changes? That mindset shift alone puts you ahead of most people because they're trained to think in numbers, not in realities. History gives us the clearest examples of this. In the Great Depression, the people who endured weren't just those with piles of cash. It was those with skills, productive land, and assets that generated real, ongoing value. In times of crisis, being able to produce something others need is far more powerful than holding a portfolio of abstract promises. That's why, in economic history, the farmers, craftsmen, and business owners who could adapt their output to the needs of the moment often emerged stronger after a crash. Real wealth is self-reinforcing. It generates value without depending entirely on the mood of the market. But here's the trap. The modern financial system conditions you to focus on appearances. High salary, you must be wealthy. Large home, you must be secure. A booming stock portfolio, you must be set for life. These signals are comforting and dangerously misleading. Because as soon as inflation bites, interest rates spike, or a liquidity crisis hits, those same assets can become anchors dragging you under. The 2008 financial crisis exposed this in ruthless detail. Millions of homeowners discovered that their wealth was nothing more than overvalued property, backed by debt they couldn't repay. Banks foreclosed, values plummeted, and the dream of security evaporated. So where does that leave us? It leaves us with a challenge that's both personal and systemic. Personally, you have to decide whether you're going to chase the illusion of wealth or build the foundation of value. Systemically, you have to understand that the financial system is not designed for your freedom. It's designed for its own survival, often at your expense. That's why the path to financial freedom starts by stepping outside the mindset the system has trained into you. The goal isn't to beat the game on its terms. It's to redefine the game so that your wealth is measured in value that can't be erased by a bad policy, a market crash, or a shift in interest rates. And this is where the historical insight turns into a personal strategy. Look at what has consistently preserved value across centuries: productive land, essential commodities, skills that can't be automated away, ownership of enterprises that meet enduring human needs, and stores of value outside the reach of political manipulation. Whether it's gold in the ancient world, oil in the 20th century, or intellectual property in the digital age, the pattern is the same. Those who own what others must have are far harder to dispossess than those who simply hold currency or speculative paper. That's the real definition of financial freedom: the ability to maintain and grow your wealth regardless of how the financial system reshuffles the rules. If you take one thing from this, let it be this: wealth is not what you're told it is. The financial system thrives when you chase numbers because numbers can be manipulated. Value is harder to fake. Value resists collapse. And value, unlike speculative wealth, will still be there when the illusions fade. Learn to tell the difference, and you'll see through one of the oldest and most dangerous tricks in economic history. Because history doesn't repeat, but if you don't understand it, it will crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.